Hello and welcome to episode 392 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leaks. Damien, how you doing? Welcome back.
I'm good. It's been an exciting week, actually, Money to the Masses, because my wife obviously was on the podcast last week. I think she actually enjoyed it. She said she was quite nervous, but leading on from that, we've had quite a bit of feedback about the piece she did regarding Too Good To Go, because that went out on social. So our social channels, YouTube Shorts, it was incredibly popular. We did a 60-second piece on our latest bag. So that proved really popular also on Instagram as well. So my wife went out and got another magic bag for £4, and it was our best yet. So go and look at our socials. That's on Twitter, Instagram, YouTube Shorts, and you'll see the 60-second clip of everything we got. So that was exciting because we had people write in and thank us for doing that piece because they're now enjoying using it. And before we move on to what's on this week's show, I did want to mention that we didn't say, or one of my favourite things I got on the app once is I actually got an £8.50 curry. So there was a takeaway curry place that was actually doing £8.50 curries, where the idea would be you'd go there and get the curry at the end of the evening, so after 9 o'clock on a Saturday. So it makes you think that you're going to get the slops of what's in this restaurant they haven't sold. But actually, when we did it and went there, they cooked it fresh. They were clearly using it as some kind of marketing. So what happened is we got two dishes, so a meat dish and a vegetarian curry, because my wife is vegetarian. We got a rice and we got a naan and we got a poppadom for £8.50. It should have cost £30. And we actually looked before we went there. The restaurant had a 5-star hygiene rating and a 5-star rating on the popular takeaway apps that are out there. So sometimes you get some bizarre things on there where people are actually using it as a marketing ploy as well. So that was pretty good. £8.50 on a Saturday night.
Yeah, and another thing I saw on social where someone had replied, they'd gone and used Too Good To Go to get their breakfast from Pret, and there was all sorts of things in there. There was porridge and croissants and bacon rolls. I mean, yeah, load up on breakfast on there. Sounds like a good plan to me. Okay, so before we get on with what we've got coming up in the show, we've got a quick announcement to make. So Damien, we've got a date for the diary for our listeners.
Yeah, so we are going to do a podcast meetup before Christmas. We've teased it. We've put a date in the diary. Thursday, the 8th of December, 2022, in the evening, so probably from about 6:30 onwards, we are going to do a meetup in central London. Mark it in your diary. We'll confirm the actual location, but it's normally going to be where we've done it before. It's most likely. So Leadenhall Market, around that area. Go to moneytothemasses.com/events, because that's where we'll put some details about what we're going to be doing and where we'll be, and we'll update that in the coming weeks.
And hopefully, because we have had requests from people to meet other members of the team, it is going to be other people, not just us. The whole Money to the Masses team.
Hopefully, Andy, hopefully we can get the rest of the team out as well. So do put that in your diary, because we haven't met people for a number of years, and it is really motivating for us to come and meet you guys and share a beer and chat about anything. It doesn't have to be about money. So please do put that in your diary.
And it is a free event. I mean, free apart from the fact you've obviously got to buy me and Damien a drink, but it's free other than that. Let's move on with the podcast. So what have we got coming up on this week's show?
Well, I'm doing a piece on mortgages, but actually a type of mortgage that is now becoming more popular, particularly in the current environment with high interest rates. I also want to talk about money. It is Talk Money Week, which is an initiative which is pushed by Money Helper, and it's an initiative to try and get people to talk about money. So I'm going to do a piece that's inspired by Talk Money Week, which is why it is important to talk about money. And the final piece on the podcast, Andy, you are going to be doing with Lauren.
Yeah, that's right. Energy again. We're going to be talking about direct debits. It's been in the news. Ofgem are not happy. There are providers that are messing with people's direct debits, and there's certain things that you can do. I'm going to mention a calculator and the steps you need to take if you're not happy about the amount you're paying on your direct debit, if you think it's not right. We'll do that later in the show.
And although you say it's energy again, this is something we've not covered in detail about how you get the direct debit down. To give you a steer, Justin in the office suddenly got notified by his energy supplier that he was going to have to pay £600 a month, which he was able to successfully challenge and change. And it was by using a simple calculator, so much so that I've used it. Everybody listen to the podcast. One task this week is to use this calculator to work out what level of direct debit you should be paying on your energy bills.
And crucially, it's got the latest information loaded into that. So even though that all these energy prices are going up, and it takes all of that into consideration, so you can rest assured you're paying the right amount.
Yeah, so don't switch off because of energy. That's the message. And also there's a new initiative that Andy and Lauren are going to be talking about as well, which means you can reduce your bills if you've got a smart meter.
Great. So let's start with the first piece then. We're going to be talking about about mortgages, and it's a type of mortgage that's been around for a while now, but we haven't really covered it on the podcast, and they're becoming a bit more popular with what's going on in the market.
Yeah, so I want to talk about offset mortgages. So we haven't covered it in detail on the podcast before. Trust me, I went back through 400 odd episodes trying to find out whether we'd covered offset mortgages before, and we haven't in detail. And the reason is more than likely because they've been relatively unpopular because interest rates have been so low. So an offset mortgage is a type of mortgage where there is a savings account that is associated with it. So what happens is typically you will have a mortgage lender. The offset mortgage you have will be linked to a savings product that they offer, so a savings account. And how it works is the interest you pay is based on the outstanding mortgage that you have minus the balance in your savings account. And the good news is that some providers allow you to link up to 6 accounts. So you could be a savings account and a current account. Now, the reason why that's good is because over time it can help you pay off your home loan more quickly if you keep the monthly repayments the same. Or you could just pay lower payments each month instead. Now, one of the advantages of an offset mortgage is the money that's in the savings account you still have access to. So you haven't overpaid your mortgage, it's still there, you can access it if you want to, but the more you have in the savings account, the more it offsets on your outstanding mortgage debt, so therefore reduces the interest you pay. Now, I want to give you some examples just to illustrate this. So, as I mentioned before, the offset mortgage wasn't as popular in the past because interest rates were so low. Now we're in a world where the margin between borrowing costs and the return you get on savings increases. It starts to become more interesting because you are getting a decent savings rate, and also mortgage rates have rocketed very quickly. So it's a way of reducing that interest. Now, the other thing to mention before I go through some example numbers is that the offset happens, but it happens gross. So interest attracts taxation, doesn't it, if you earn above the savings allowance. And if you have significant savings and you use an offset mortgage, well, that offset happens and it means you avoid the taxation. So let's say you had a large pot of money. Rather than pay tax on the interest that you receive, what will happen is the equivalent interest is effectively offset against the interest on your mortgage. So you end up making a tax saving. So it means that it is attractive to people who pay high levels of income tax. So I want to give you some numbers, and First Direct do a really good calculator, which we're going to put a link to in the show notes, and we're also going to put it in the article on the website. And the offset mortgage calculator, you just bung in a few numbers and it tells you the potential saving. I'm going to give you an example, okay? So let's say that you had a mortgage of £250,000 over a term of 25 years, and there was an interest rate on that mortgage of 5.96%. So using an offset would save you £297 a month. That's because without the offset, you would have been paying £1,240 a month. With the offset, it reduces down to £943. Now, of course, that is, if you go down that route of using an offset just to reduce the payments a month. I mentioned earlier that technically you could do another option where you use an offset to pay off your mortgage sooner. Basically, you're overpaying if you kept the level of monthly payments as high as the level you would have paid if you didn't use an offset. Now, that makes offsets quite interesting. Now, there are pros and cons, and I want to go through them quickly. I've mentioned you can benefit from using those savings without losing access to them. And there is the tax saving as well, because don't forget you pay tax on savings interest, but under an offset mortgage, the offset happens tax-free. Now, they are particularly useful for certain people. If you're self-employed, for example, and you have large sums of money that are building up over time, it may be you've got money that you keep aside for, maybe it's taxation. It could be for people who have money they keep aside for other things. It could be school fees. It could be you're keeping money aside that you might want to use for your children in the future, be it to help them get on the property ladder or something else. But there are disadvantages too. So one of the big disadvantages is there aren't many options out there. At the moment, there are around only 9 lenders who offer offset mortgages. So they haven't been popular, and a lot of them have been pulled, and actually they've been pulled perhaps more quickly than standard mortgages. With an offset mortgage, you will typically pay more than you would on an ordinary standard mortgage. So bear that in mind. And that's down to competition because there are less best options out there. Obviously, using money for an offset over a long period of time, there is an argument that if you are happy with money being tied up for a long period of time, you may be better off using that money in another way. Investing, for example, so you would get a better rate of return. And if the rate of offsets that you see out there are particularly high, you might be better off actually saving your money to overpay on a standard mortgage. So we've talked about overpaying in the past on the podcast. But of course, you can overpay on a offset mortgage technically, and it does depend on your terms and conditions of your mortgage. So normally 10% is the standard. So 10% of the outstanding mortgage each year that you can overpay. But with an offset mortgage though, instead of overpaying, you can just add money to the savings account, which will reduce your monthly interest payments further. So at the end of the mortgage deal, you can use the savings that you've built up to pay off a chunk of your mortgage anyway. So the result is the same as overpaying, but you won't actually face any early repayment fees if you start piling money into that savings account. So for that reason, it can be quite attractive to people. The other disadvantage with an offset, you need a decent level of money. If you don't use the offset, then you end up just paying more for your mortgage. So a number to sort of use as a benchmark, you will need a large deposit of around 20%. With some lenders, it's about 25%. So that is one thing that will put off many people. Also, some providers will insist that the savings account and the mortgage account are both with them. That is kind of understandable, to be honest. And although you can access the money in your savings account, there can be minimum withdrawals. So it might be something like £250 each time. So that is something else to bear in mind. Now, I just want to talk about the rates quickly and compare them. Now, a 2-year average fix according to Moneyfacts, so a fixed rate offset at the moment, as I make this podcast, is 5.52%. Now that compares with 6.5% for the traditional loan. So that actually goes against the traditional idea that offsets are more expensive than standard loans. But when I've looked around, so for example, I went and looked at First Direct and I compared their 2-year fix, because don't forget, even though it's an offset, you can still get different types of mortgages. So you can get a fixed, you can get a variable if you want. I looked at the standard 2-year fixed offset mortgage with First Direct, and that had an initial rate of 5.96%, while their standard 2-year fixed rate was only 5.84%. So it was marginally more. So that's why offset mortgages are now starting to become a bit more attractive. So the message really is, when you go to remortgage, and as I always say to people, go and speak to a mortgage advisor, you can mention to them about offset mortgages. It's an option now. You don't just have to think, I've got a fix. There are other options out there, including an offset. So those of you who were listening, the example I gave earlier on the offset mortgage was actually using the rates that I mentioned from First Direct. So really what I did was compare using their fixed rate mortgage, their standard 2-year fix versus their 2-year offset. Now, of course, the rates will change after the fixed period, but it gives you an idea of what you're likely to save if you do decide to use an offset. So it is a viable option for people now. Do think about it, talk to your mortgage advisor. And the other thing I just want to throw out there as well is that I was doing a piece earlier in the week about early repayment charges, and I was looking at different rates and different mortgages, and trackers are now becoming more attractive to people because the rate that you can get on the 2-year tracker, so let's say it's for £200,000 at the moment over 25 years, you can get a rate of 2.95%, which equates to a monthly mortgage repayment of £943. The best 2-year fixed rate you can get at the moment is 5.43%, which equates to a monthly mortgage repayment of 1,219. So it's £1,219. And you might be thinking, how do they do a tracker that cheap? Well, it's because the base rate hasn't actually got there yet. The base rate is only 3%, and the tracker will track that base rate for the agreed period of time, in this case 2 years. So that's why it's lower. The fixed rates are based upon future projections of where the base rate might be, as well as the bank's ability to borrow money and gilt yields, all of those things. So that's why you've got that disparity. But of course, what will happen is that when the base rate goes up again, then the tracker will start to shoot up. But there are more people starting to pick trackers with the idea that they will potentially fix later in the future when they believe that the fixed rate deals will have dropped below where they are now. But they are playing the interest rate game a bit there. So I'm just pointing it out to people because, again, like this offset idea, there are other options out there for people, including discounted mortgages, which is where you have a mortgage and the initial rate is discounted below, for example, the variable rate that the lender usually offers. So options for people to think about. And one thing I'll have to say is that people will be thinking, well, if the base rate's at 3 and that tracker rate's 2.9, that rate won't have reflected the recent change in the base rate. The base rate would have been 2.25 when that tracker rate was set, and it probably, you'll find, it is now pulled. But it gives you an idea that it is distinctly lower right now than the best fixed rate deals.
Okay, so let's move on to the next piece then. Talk Money Week. Damien, you talk about money every week, but you're going to talk about money this week specifically.
Yeah, it's like a version of Inception. We're going to talk about talking about money. It's Talk Money Week, which obviously we do it all the time, and it is part of that belief that we should talk about money, which drives us to do it because we can help people. So seeing that it was Talk Money Week, I wanted to do something slightly different and discuss why it's important to talk about money, because I want to run through some reasons why I believe it is to get people to think a bit more. Now, there were some stats I saw which emphasizes one of the points that talking about money is always the first step to dealing with problems with money. So 1 in 5 callers apparently to the national debt line and business debt line take between 6 months and a year before they actually contact them. Now, almost a third wait 2 years or more. But also, they found that 95% of callers to the national debt line said they were clear on their next steps after seeking advice. And it was the same for the business debt, which is an incredible statistic. So basically, by talking about it and opening up about money, they were able to then get not only help, but get a course of action. And the issue we've got in England, well, Britain, is we're very British. We don't talk about things like that. We don't talk about money. And it's one of those things that we do really need to change. And when we say talk about money, it's not about being boastful about how much money you have. That's not what we're discussing here. This is being open about some of the things that surround money. Debt. There's nothing to be ashamed of having debt. It's something that's got out of control. And the thing is, most of us have been there at some point. Your 2 hosts on this podcast have at some point had debt that they wanted to get under control. It's something that happens. We do live in a world where you are encouraged to take on debt when you are young. And the lenders want you to get into this spiral because they make money from you. So unfortunately, we're having to talk about it to get people to understand that. And so particularly young people, if we talk about money more, then what we can also do is we can help people not fall into the same mistakes or avoid the pitfalls that are out there. The world is a dangerous place. And so there are examples of where institutions deliberately go after younger customers who are maybe naive. I mean, I certainly was when I was young. A good example of things like student bank accounts. It may be credit cards. They will give you bank accounts, not because they like you, because they know that in the future you are likely to earn good money, which they will likely be able to sell you more products. And most people stay with the same bank throughout their life. And therefore, most people go to their bank to get a mortgage, which is a huge debt they make lots of money out of. So it's not because they like you. This cycle, people need to understand, if we talk about these things, how it works, then you're armed with that information to be able to make better decisions. And the other thing is, it's a bit like people who have past experience of something that went wrong. You see these things where you get reformed gang members, for example, who go and talk to people who may be following the same path as them, and they warn of the dangers and what can happen to people. It's no different if we talk about money more widely and just things that we did well that went wrong, or the things that scams or whatever it may be, then we can help other people and we can learn more. Now, one other point is, if we talk about money, I think that an important part of it is that we start to see the warning signs as well about how our relationship or other people's relationship with money is starting to either go out of control or could go out of control. Now, an example of that could be if you're in a relationship where somebody is starting to control you financially. And it may be something that happens slowly over time, and people don't actually realize that it's one form of domestic abuse. And so, unfortunately, it can feel normal to people who are in that situation that somebody's controlling the money. But that shouldn't be the case. And so by talking about it with your friends, people will then realize that that isn't normal, that isn't okay, that people are being treated in a certain way, and it doesn't happen in other people's relationships too. So that is another reason why I believe it's important to talk about it. The other reason is we don't teach people in school enough about money. Now, we have some financial education lessons, but when I talk to my daughter, for example, there's very limited, if anything, they get taught about money. And I mean real money in terms of experiences they're going to come across, how mortgages wages work, for example, how debt does, how you grow money, how you invest, the importance of money, inflation, all of these things, if they're not being taught it, all of us can probably agree we wish we'd known now back when we were younger, because there would have been a lot less mistakes that we all made along the way, and we'd be probably more financially secure at this point as a result. And also, if we talk about money, then you're likely to encourage children to have some good lifelong money habits as well, which will put them in good stead. And the other thing for me, the reason I think talking about money is important, because every day is a learning day. So every day is a school day, I suppose, is the real phrase that people use, because don't think that I know everything about money. I don't. I'm always learning. I'm always looking for new ideas. I'm always looking at new things that come out. It's changing. If you go back just a decade, the world of money is very different. I mean, now we have technology like apps. We have things like app-only banks, robo-advisors. We're able to invest. You go back to when I started my career in the city, so going back over 20 years, basically only wealthy people could invest, and they were charged a fortune to do so. And so by talking about money, we learn about new things as well, and talk to lots of people about money. Don't always just talk to your elders, because their views on money aren't always as relevant today as they were when they were younger, because the world has changed. They have moved on. And if you just think about this week, we look at what's going on in the crypto space, the complete carnage. Well, we are in a very different world to what they were when they were younger. The other reason, and this is a big one for me, is empowerment. So some of our most popular podcasts were our How to Be a Millionaire, which is podcast 283. Black Economics Matters was another one, and that was podcast 276. Now, if you talk about money, you can start to pull down those walls of inequality that occur. So one of the things about being a millionaire, that podcast, is it was all about as well intergenerational wealth. It was about how you could use very simple ideas to become wealthy over time. And if you teach this sort of stuff to people when they're younger, they can take advantage. And with the Black Economics Matter podcast, we're very proud of that episode. So if you've never listened to it, please do. But one of the points that came out of that is when people don't own things, then it's very hard for them in society to be able to get a foothold and be able to make change. And so that is part of this idea that if you educate people, you then start to realize about the privilege that you have as an individual, and therefore you can use that as a tool for good. Another reason that you should talk about money is that people find out about the financial help that's available to them. So they may be having a conversation with somebody in the pub and they might not realize, for example, that there is some help that they can apply for during the cost of living crisis. Or it could be, for example, that somebody was starting to lose their child benefit because their earnings have got to a certain level, but they didn't realise that they can actually make changes to their earnings that enable them to keep their child benefit. And so those sorts of things, if people talk about money, they start to learn, because let's be honest, most people don't know what they don't know. That sounds an odd phrase, but there is that kind of serendipity that you just discover stuff. And people go, did you know, for example, that grandparents can get national insurance credits for looking after their grandchildren if they're under the age of 12 and the parent has gone back to work but is claiming child benefit? If you didn't know that, that is actually true. Those sorts of things come up and people find out about the help that they can get. You also learn tools and tricks that we useful when you're dealing with money that other people might know. It may be something as simple as not impulse buying and waiting 48 hours to buy something. You also might learn about budgeting. You'll also start to learn about what happiness really is, and that money doesn't really buy you that. It makes life easier. It gives you choices, but it isn't necessarily the ultimate destination. But you also start to learn a bit about value. So that means more about how much things cost based upon your hourly earnings. And the other one, going back to empowerment, that if we talk about money, it starts to bring down some of the barriers that we have for not only people in different ethnic minorities, but also based on gender. So if we start talking about money more, the issue is the people who don't want to talk about money and want to hide behind an anonymity, they're sort of, this is private, often are the people who benefit the most from doing so, the wealthier people. And that's because if this, say everybody knew, for example, it was widely known what people's wages were at certain types of jobs or in certain industries or companies, it would be very hard for companies to justify not paying equal pay. Now, we've made some progress on this, but there's still a lot that we can do. And so by talking about money, then I think we can start breaking down some of these barriers. Also, things like I talked about in a podcast, GDP numbers, so our economic numbers that governments make decisions upon, don't include childcare at home. So given that that's done predominantly by women, that's automatically dismissing what they're doing as not being valid or worthwhile. So by talking about these things, you actually realize some of the injustices that are out there, and you're more likely, as somebody perhaps who's benefited from the way the world is, you're more likely, therefore, to try and change things. The other thing is, talking about money can also help build stronger relationships. That can be particularly in a marriage. So one thing you've got to realize is that it's okay for people to have different views on money. Don't forget that people have come from different backgrounds. Everyone has their own baggage when it comes to money. So if you think about somebody's money that they've made over time, they have made that in a certain way. That is something that's emotional to them. And also, don't forget that people who've grown up in different families, money means something different to them. So if you grew up in a family that had plenty of money, then it might be more of something that's an opportunity. It gives you things. Whereas if you grew up in a family or an environment where money was scarce, it was maybe something that caused sort of pain, a lack of it. And when you had it, the feelings that you had about it was more about keeping it, if that makes sense. So when you are in a relationship, one of the things you have to realize is everyone's different. And there is no perfect solution about money. That's the other thing. People feel failures about money. Realize that we're on a different journey. So when we talk about it, we understand that. We don't feel bad about decisions that we make. We make the best ones we can. But we also start to realize why people think about money in certain ways. And then we can somehow meet in the middle. And the other thing is, this goes back to the black book principle that we did in podcast 304. It is difficult to start conversations about money. I know it is, even at home with your partners. But if you build a black book, that is a great starting point to talk about money, because the black book was where you pretty much pull together everything to do with your finances. So you take ownership of what's going on, and you put down all of the information about policies that you have and money that you have, investments, but you end up sharing that with your partner if they don't know about it, in case you basically get hit by a bus. But there is an empowerment there that they know what's going on as well. And therefore, as a collective, it's far easier to have a similar view on money and to be able to achieve goals. But that's because you're talking and discussing it. It doesn't mean you've got to just talk about how much money you spend every minute of the day, but it means that you're on the same page. And the other thing is, one of the reasons they found doing research that people don't talk about money is because they're worried about it. They bury their head in the sand, and they're also worried about putting on other people if they communicate with them about it. Once you start talking about money, the opposite can happen, because you can start to deal with things and it can reduce the anxiety that you might feel. And actually you realize that everyone's in the same boat, and you actually also realize that you probably learned from listening to the podcast, you can't control everything in life, and therefore there are certain things you've got to worry about and certain things you don't. And if you have a plan in place, then that's about the best you can do. So that is why I believe you should talk about money. There are lots of other reasons why you should talk about money that I probably haven't mentioned, but just think about it. How do you talk about money? Do you talk about money? If not, why don't you talk about money? And can you talk about money differently as well? Are there ways that you can take on other people's opinions? Don't just railroad people with your own view on the way money works. It's the one thing that I've found in the world of money, is that people do railroad each other. They just have an opinion. This is the way you do it. And if you have any other opinion, then it's actually completely invalid. It doesn't work like that. And if we talked about money a bit more, we'd realize that. And the final thing I want to leave you with, if we don't talk about money, and it kind of links back to something I said before, it means that the current structures that are in place remain that way. The people who are incredibly wealthy, who benefit from intergenerational wealth, the system as it is would always remain the same, because it's that kind of divide and conquer idea. We're all in our little silos. We don't want to talk about it. If we did, we'd suddenly realize that actually things perhaps should change. And then that links quite nicely onto, I don't talk about politics, but it also, particularly for young people, if you talked about money a bit more, they might actually be inclined to go out and vote, which is something that money and politics and all these things are ultimately intertwined in a certain extent. So there we go. Make sure you talk about money in a positive way and don't boast about it.
Okay, so let's move on to the final piece of the podcast. So first off, we're going to talk about something that's been happening to a lot of people with their energy bills, specifically looking at direct debits and what people can do if they believe that their direct debit has been set too high. And Lauren will be joining us at the end of this piece of the podcast to talk about something that could help some people save money on their energy. It's a new scheme that's in its infancy right now, but it's worth mentioning it on the podcast because some people may be able to sign up for it. Okay, so this piece comes on the back of an announcement that Ofgem made way back in July, saying that they weren't happy with the way that energy firms were setting direct debits for their customers. And it reviewed 17 of the largest suppliers and found that hundreds of thousands of customers were seeing their standard variable direct debit increasing way over what was the latest cap rise at the time. In fact, many people were seeing that their direct debits were being doubled, which they deemed as unfair. So they ordered these companies to have a look at their processes and to basically sort it out. Now, the reason we brought it up on the podcast this week is that this is still going on. This was back in July that this review was ordered. We're now well into November, and we're hearing anecdotally through our Facebook community group. Also, people have been emailing us, and even Justin in the office has personally experienced some issues with his company doubling his direct debit without any real reason. So let's look into what's actually happening here. In fact, let's use Justin as an example of what's happened. So Justin got an email seemingly out of the blue because he's been doing his regular readings and paying his monthly direct debit, and he's not been paying a small amount each month. In fact, he's been building up credit by paying £350 a month on his direct debit. Yet he was sent this email out of the blue saying his new monthly payment would be £640, effectively almost doubling what he was already paying. And the thing we really want to highlight on the podcast here is this wasn't a suggestion that Justin should increase his direct debit. This was a notification to say that his direct debit was in the process of being amended and his new payments would be £640 a month. Again, let's just clarify that he already had a credit of over £700 sitting in his account and he was already paying £350 a month. So Justin looked through the details, looked at the numbers, and he found some account summaries by going online and checking with his energy supplier. And those summaries looked fairly normal. They were based on average usage over the 12 months, based on real readings, not estimates. And when you added the gas and the electricity together, they only equated to just over 3,600 annually, which again, when you extrapolate that back to a monthly figure, means that the amount he was paying, £350 a month, was just about right. Yet the predicted energy usage on this new summary, where they had forced him effectively to change his direct debit, suggested that it was near 8,300 per year. So what Justin had to do in the end, because there was no way of doing it through the online system, was to give someone a call, explain the situation, and try and dig into the details and find out exactly what had happened. Now, ultimately, Justin was told that there had been a bit of an error within the system. It's something to do with the fact that his estimated usage was being automated, and there was something in the algorithm that was playing up. And he was even warned that even though he'd called, and he did manage to fix it, by the way, he did manage to revert his direct debit to what he was previously paying, which was the right amount based on his actual usage. He was warned that this is likely to happen again due to the systems that are in place, which sounds a little bit crazy. So that's what happened to Justin, and we know that it's happening to hundreds of thousands of people out there who are already worried about the cost of living, and obviously Christmas is just around the corner. So to finish this piece, what I'm going to do is I'm going to give you some steps that you should take if you believe that your direct debit is too high, and also provide you details of a really good calculator so that you can use that information to speak to your supplier and get your direct debit sorted. So the first thing to mention is that the calculator only works for people who are on the standard tariff because of the way that the energy price cap works. If you've already fixed, the calculator won't know what you fixed to, and so it won't really work. So if you're on a standard tariff, this is for you. So I'll let you know the address of the calculator now. I'll read it out, but we'll also provide details of that in the show notes on this podcast and on the article on the Money to the Masses website as well. So it's moneysavingexpert.com/utilities/lower-energy-direct-debits. I know that's a lot to remember and it's a long URL, but the details will be in the podcast show notes. In order for the calculator to work right for you, you'll need your annual usage, and you can get that by logging into the online portal with whoever your supplier is, or you can, if you get paper statements, you can check your statements and you should have the details on your most recent bill. If you can't find your annual usage, you can of course use your most recent bill to check your monthly usage, but just be aware that that won't be entirely accurate because it won't have the seasonality. It will just be based on that 1 month, and obviously you tend to use less in the summer and more in the winter. So your annual usage is much better for this calculator. You simply need to put in the amount of kilowatt hours per year for your gas and also your kilowatt hours per year for your electricity. That's if you obviously have got dual fuel. If you only use electricity, then great. Just put 0 in your gas usage and then the amount in your electricity. Next, you need to select the region that you live in. So there's a down arrow there and you just need to look through the regions and select the nearest one to you. and then simply click calculate. And the calculator will produce almost instantly a coloured chart of your estimated annual energy usage. And the bar chart will show what you were paying previously. And by previously, it means prior to the energy price guarantee introduction on the 1st of October. It will also tell you your new amount, i.e. the current amount based on the energy price guarantee. And helpfully the lower bar there in pink on that graph will actually tell you the real term cost to you, factoring in the energy bill discount, which is the £400 that the government announced that they would help people with earlier on in the year. So once you've done this calculation and you've got your figures, compare that to what you are actually paying. And now you're armed with the information to go back to your energy supplier. And so there's a few steps that we recommend that you take. The first thing you need to do is take an accurate reading before you give them a call. That way they're going to have the most up-to-date information. Another thing you can do in the next step is check how much you're in credit by, because if you are disproportionately in credit, then you can actually ask for some of that money back, because it is your money after all. And if it isn't in line with what you should be paying, and that credit is likely to be just sitting there in their account, then it's better to be in your account. But of course, keep in mind that once you've effectively withdrawn your money out and you've taken that back, there's no longer that buffer sitting on your energy account. And so if energy bills do rise in the future, you need to make sure that you keep an eye on how much you're paying each month to keep on top of that, so that you don't go into debt with them. The next and probably most crucial step is to engage in conversation with someone who can actually make a decision and make the changes that you're going to request. So you need to speak to someone about your direct debit and explain why you believe that the direct debit you've been set on is much too high. And again, you've done your calculations, you should be able to prove that to them, because it could be that in Justin's situation, for example, there's some sort of weird algorithm that's going on, or it may just be an error on their system where they've miscalculated your annual usage. So have a conversation with them, and there's a very good chance that they'll be able to amend your direct debit for you. Just a point on that, if you are slightly in debt to them, if your account is in debit, then what you could do is you could pay off that debt if you can afford it, which might give you a little bit more leverage when it comes to explaining that you want to reduce your direct debit. They may be more willing to work with you if they can see that your account isn't in debt. And the final step, if you haven't had any success when you speak to them over the phone, is do make your intentions clear that you wish to take the matter further and that you'll be writing to them. And one thing that's worth mentioning is the Energy Retailers Code. And that is a code of practice by which energy firms need to adhere to, and make it clear that if there is no change, that you fully intend to move suppliers. And so there is a possibility then that they know you're taking it seriously, and so it may not be worth their while to continue fighting it, and you may find some success on going down that route. And if all of those steps don't work, the final step would be to complain officially to the Energy Ombudsman. And we'll link to an article on the website in which you can find the calculator and all of those steps that we've just mentioned, so that hopefully you can get this resolved if you're in this situation. Right, and so let's bring Lauren onto the show then, who's going to be talking about a new scheme that's been launched that could help people save on their energy bills. Lauren, welcome to the show.
Yes, so the Demand Flexibility Service is a scheme that has been developed by the National Grid, and the idea of the scheme is to try and combat energy supply when it's at its peak point. So when everyone is using energy, normally between the hours of 4 p.m. and 7 p.m, cooking dinner, baths, showering, putting washing on, things like that. They want to try and reduce energy consumption at these points. So the idea of the scheme is that energy suppliers sign up to the scheme, and then energy customers get rewarded for reducing their energy consumption during peak hours. Now, the scheme launched by the National Grid is encouraging energy suppliers to sign up. It's not just for domestic customers. There are some opportunities for businesses to also sign up for the scheme, and you get rewarded if you reduce your energy usage. Now, currently, there are a select few suppliers that have signed up to the scheme. Octopus Energy was one of the first suppliers to actually sign up to the scheme. And they initially ran a trial with the National Grid earlier on this year. And the trial was really successful. And it found that the incentive for customers to save money on their bills helped them to try and reduce their usage during peak times. E.ON Next have also recently announced that they're going to be joining the demand flexibility scheme. And in most instances, if you are on an energy smart meter, you can participate into the scheme, because one of the caveats of this scheme is you do need to have a smart meter that can record meter readings every 30 minutes. So how the scheme works varies depending on energy suppliers, and your energy supplier will contact you if you are eligible to take part in the scheme, and some of them may give you personalised targets of when you can reduce your energy usage and by how much, and how much you will be paid or rewarded for reducing your energy usage can vary with suppliers. Now, there are some energy suppliers who aren't actually taking part in the demand flexibility service, but have launched their own schemes. So an example is OVO Energy. They've launched one of their own incentives to try and encourage customers to reduce their energy usage. Utilita Energy are also launching a power payback scheme, which has a similar incentive where it encourages consumers to cut back or reduce their energy usage during peak times throughout the winter months. So these schemes are going to run from November to March 2023. The National Grid's demand flexibility service is currently under a trial. So any energy supplier that has signed up to the scheme and the service is currently under trial, and they are going to decide if the scheme works in the long run and exactly how it will work. So if you are eligible, you will be notified by your energy supplier, but you can contact your energy supplier for more information. And if you aren't on a smart meter, then this may be something that you wish to consider so that you can benefit from these schemes. So because there are only a select few energy providers who have signed up to these kind of schemes or are offering their own versions of the schemes, in the meantime, you could be conscious of your own energy usage during peak times anyway, and in turn, this will help you to save money on your energy bills. We also have a host of tips on how to save money on your energy bills over on the Money to the Masses website.
And as always, we'll link to those articles in the show notes so that you can find those nice and easily. So, Damien, let's bring you back in. We're done for this week. If you want to get in touch with Damien, you can do so in the usual way. It's damien@moneytothemasses.com. But a good way to get in touch with the show and like-minded listeners is to go to our Facebook community group. Go to facebook.com/groups/Money to the Masses. And as always, we're going to put links to everything we've talked about in the podcast today in the show notes of this podcast, but also on the article on the Money to the Masses website. Find Money to the Masses, type in 392 and you'll come to the podcast and you can see all the details there. And so, Damien, that's it. We're done for this week, aren't we?
We're done. Until next time.
Until next time.